Hello, everybody. Dr. Richard Smith here with the Foundation for the Study of Cycles, and we are back for 2025. I hope everybody had a great break, got some good rest, and is ready for action in the coming year because it's going to be action-packed, no doubt about it. And I'm really excited and gratified about the community that is growing up around the Foundation for the Study of Cycles and engaging with our work, because this is about us all navigating tricky times together. So we have our advanced group, the master working group, that met yesterday for our first meeting of 2025, and it was amazing to collaborate with serious market and cycle practitioners at the highest level. And everybody is on edge right now. I mean, just no other way to say it. Markets are edgy. We've seen that in the action already this year. Lots of dramatic swings, big swings, news-based swings. Nobody really knows for sure whether we're headed straight down or straight up, right? Both scenarios are in play. And so it's an edgy time, and it's a good time to stick together, and a good time to help each other, and a good time to dig into cycles and how they can enhance our other tools and get us through this year together. On that note, briefly, I am personally offering a three-month coaching course coming up here starting in the end of January, and would love to share that with you. If you are interested, there'll be a link in the info for this event. So if you're interested in learning more about risk management and my whole approach to markets, I'd love to share it with you. All right, so today I'm going to share with you something that I've been watching for 24 months now and has changed. And it is my recession indicator. And it's already been extremely helpful to me in terms of keeping me out of the recession worries, right? Keeping me long. And now things have changed, and the recession watch is on. The recession isn't here, but my recession situational awareness, let's just say, has significantly changed. So going to share that with you, and then we'll kind of take a look at what's going on, big picture, especially with stocks and bonds, and see if we can set ourselves up to be attentive to what's going on with markets and what we need to be watching out for. So with that, I will make some adjustments here and we'll get started. Nope. Yeah, that'll probably. Okay. One moment. All right. So this is a back test that I put together probably a couple years ago now. And you can see that see, if we start down here, this is a buy and a sell and a buy and a sell and a buy and not yet a sell. Okay, but getting close. I'm going to talk more about that in just a minute and what this is. And it didn't catch the tops or bottoms perfectly. That's not what this is about, right? Maybe that's where cycles can help us. And didn't catch the, the bottoms perfectly either. So this is the, get the meat in the middle type of system. And this is the back-tested stats, the return 3,716% versus 1,561% for buy and hold. Gonna actually go down. So what is this system? Well, it's based on two things. One is the spread between the 10-year Treasury notes and the 3-month T-bills. And I've shared this before. Sorry, my voice is breaking up already. Too early in 2025 to have my voice going. Okay, so this is going back to 1982. This is the yield on the 10-year Treasury notes minus the yield on the 3-year T-bills. Normally, if you're tying up your money for 10 years, you want to get paid more than you do if you're tying up your money for 3 months. But sometimes that inverts, right? And so we see those inversions when the 3 months are yielding more than the 10 years. And so we get a negative number, which we have down here. Back in 1989 or so, we had here in 2000, we had here in 2007, 2019, and WOA, unprecedented here in 2023, 22, 23, 24. And these gray lines here are the recessions. 2 quarters or more of, not growing GDP, I think. So you can see that, it's not when the curve is inverted that we need to be worried about a recession. It's when the curve uninverts. And then it typically takes a little time for those recessions to get started. So we have, in the past few weeks, uninverted in a significant and decisive way. So that's the first component to this signal. Uninverted 10-year minus 3-month yield curve. There's one other piece to this, which is the 200-day simple moving average. So this is a very simple system, no cycles involved here at all, okay? So what you can see here in the price line, which is the blue, the S&P 500, where it's blue, and then red is where it inverts, and blue is where it uninverts. And the second indicator here is the 200-day simple moving average. So we're looking to see if the S&P is below the 200-day moving average and if the yield curve uninverts. So we can see the trigger here where the yield curve uninverted and price was already below the 200-day moving average. Okay. Over here, the yield curve uninverted, and then price went under the 200-day moving average. Same here. And now here we are today. The yield curve has uninverted, the 10-year minus 3-month, but we are not below the 200-day moving average. So this is not a sell signal on this system yet. Here's just a little clearer picture, more recent history on the S&P 500, where it's at, and where the 200-day simple moving average is at. So got a long way to go to the 200-day moving average, from 6,000 basically down to 55, 60. So what is that? That's a significant 7-8% drop that we have to have in order for this indicator to trigger this sell signal. So it hasn't triggered yet. And this is one of the things that's kept me long all this time, and that still has me cautious. But again, my situational awareness level has increased. The homeland security, threat levels. When do we need to be more situationally aware? It's the same in markets. So now we have the unprecedented, inversion in this yield curve, right? I mean, this goes back to 1982, and there is just, nothing like this inversion that we've seen. And now we have uninverted in a very dramatic way from being the most inverted we've ever been. Situational awareness heightened. Here's the longer term, broader Treasury yield curve as of today. Okay, so here's the 3-month at about 4.35, and here's the 10-year at about 4.6. Okay, so the 10-year is higher than the 3-month. If we go back even just a month, okay, we see the 3-month here at 4.5, and we see the 10-year here at 4.2. So we were still inverted. Again, the blue is today. That's going to hold steady. And the red is just shifting back into history a little bit and comparing the yield curve from, say, a month ago to today. So again, we're uninverted. Today, 10 minus 3 is higher, whereas just a month ago, we were inverted by a couple of basis points. Here's what it looked like 1 year ago. So 1 year ago, the 3 months were at 5.4, and the 10-year was at 3.9. Okay, so if we go back up and look at this inversion one more time, that was getting down here near the lows of, almost nearly a 2 percentage points in inversion, 200 basis points. And, then you can see even within the past month how we've really uninverted dramatically. All right, so that's the picture in terms of the yield curve, uninverting. And also, it's not insignificant that the 10 years are now at 4.6 versus, a year ago at 3.9. So that's a big rise in yields. So we're getting the long end of the curve steepening. And this is a cause for concern too. If we see yields continue to go higher, the 10-year in particular, that's putting a lot of pressure on interest rate sensitive investments like mortgages, for example, and annuities is another one. If these long-term rates continue to go higher, that is, some people call it the bond vigilantes, right? Putting the US government's policies to the test around fiscal policy. So obviously our debt is very high, and the risk of defaulting on that debt is higher than it has been when we haven't had debt levels so high. So this is a big question hanging over markets. Are long-term rates going to keep going higher? It means bonds keep going lower. Bonds have not broken out of their bear market. So Some other data to look at. We've looked at this recently, but this is the sentiment data, commitment of traders data on the stock indices, right? We know we're below the zero line on the S&P 500 and the NASDAQ. So the commercials, the smart money are still cautious on stocks. Same with the Dow and the Russell. So all the major stock indices are not being accumulated by the commercials. And on the other hand, the small trader continues to be pretty bullish on stocks. But, definitely a little more nervous after the pullback that we had instead of getting the Santa Claus rally, which we didn't get, right? Instead, we got some volatility and some correction. All right. Just a couple other things that seemed relevant to this conversation before we get into cycles. Okay, this is the personal savings rate. All this data from the Federal Reserve, from Fred. The personal savings rate has definitely been decreasing, okay, over the last year. And it's down near some relatively historic lows. So we're not saving much in America, certainly not as we have in the past. This is total balances on credit cards for the U.S. consumer from large bank consumer credit card balances. It goes back to 2012, and we are racking up credit card debt amongst our consumers. And not only are we racking up credit card debt, but the rates that the banks are charging in terms of interest rates are going up. Commercial bank interest rate on credit card plans reaching into the 20%. These are not all signs of inflation abating. Interest rates on mortgages haven't gone down. Interest rates on credit cards are shooting up. Interest rates on 10-year and 30-year government paper from the U.S. government are not going down. So these are all red flags, high indicators of the need for increased situational awareness, together with the cycles that have we've looked at together a lot, especially around equities, and we'll revisit that briefly. And unemployment's been going up also, right, over the past year. So still at reasonable levels, but it's definitely been on the rise. And of course, we've been following this 180-week, 41-month cycle, and we know that it's topped. Well, that the cycle has topped. Doesn't mean the stock market has topped. We can get right translation here, but the cycle in equities is at a top. So I think that's it before we get into cycles. So let me stop there for a minute. And see if anything is on your mind. Hello, everybody. Canada, Cincinnati, Chicago, Geneva. And yeah, interesting times, right? So I think all that important information that we just talked about is definitely something that we have to be keeping in mind, have to be watching together. I'm interested if any of you see it differently than I see it. So if you do, would love to hear from you. But the basic setup here is that the uninverting of the 10-year minus 3-month yield curve together with a cross below the 200-day simple moving average has more than doubled the performance of the S&P 500 if you took those signals. And we've gotten the biggest inversion in that yield curve, in that yield spread, I should say, since we've been tracking it. And it's just uninverted, but we're not below the 200-day moving average. And bonds and interest rates in general are not behaving as though inflation is under control. So that's the big picture. All right. Now we'll take a look at what's going on with cycles. So these are, I've shared this with you before, but this is my cycles dashboard on the futures markets that I pay attention to. And we have 1 minute, 2 minute, 5 minute, 15 minute, 30 minute, hourly, 2 hour, 4 hour, daily, and weekly. Okay. And there's 2 types, persistent and dominant, for each time period and cycle length. Come on. Okay. All right. So we can see here, if we look at treasuries down here at the bottom, okay. Yeah, come on. That, definitely like on the 15-minute, getting some green signals because they're oversold after this morning's jolts and ISM data that jolted the market. And then longer term, nothing really jumping off the page. But if we look at the daily data, we've got some -4, -3, -3. Those are all, leaning on the buy side. Over here on the 4-hour data, some +4s, etc. So let's look at the 10 years treasuries and see what we can see. We'll start with the 4-hour data. So here we are looking at the 10-year treasuries on the 4-hour data. We've got some pretty good cycles here. The 84, the 109, and the 178, and the 84 and the 178 are, pretty close to 1-2 harmonics. And if we go here to the latest data point, we can see that all 3 of these cycles are red or topping red. So we've actually got a sell signal on the 10-year, which doesn't bode well for a relief rally here in treasuries, 10 years. If we go to the daily data and take a look what's going on there, we got this 172 jumping off the page. Actually, let me change to the profile one so we can get the AI rankings. So we got this 172 jumping off the page here, and also this 88. What's 88 times 2? 176. So on the daily data, for the 10-year, we can zoom in here a little bit and go full screen and maybe turn on my cursor tool. Cursor Lux. And we can see that, we don't quite have a momentum buy signal here yet, but we do have some reason to be a little hopeful that maybe by the spring, we'll get some rally in 10-year treasuries and a reduction, which would mean a reduction in rates. But, we're not out of the woods yet on the 10 years for sure. So if 10 years keep going up, the rates keep going up, if prices keep going down and rates keep going up, right? That means likely that those spread between the 10 years and the 3-month is going to keep widening. And it probably means that the S&P 500 isn't going to be off to the races if rates in probably the biggest government paper instrument in the world, the 10-year Treasury, is going down and rates are still going up. So if we look at equities, right? So here's equities. Obviously wouldn't, be the move down this morning has created some up cycles. And we can see here on, which one is this? This is the E-mini. On the daily data, there's some buy signals going on. The 83-day, I think Lars covered this yesterday on his cycles show, right? So we actually have a pretty good buy signal from the cycles on the daily data, the 80-day, 83-day data. And you can see it on the chart here, popping its head up in the spectrum. Number one cycle. And then this 187, not quite as bullish. But the daily data is not, saying that the end is nigh. Meanwhile, the weekly data, of course, we looked at that earlier. So not, a full-blown panic signal in equities right now, especially with the S&P 500 still significantly above its 200-day moving average. So, a lot of overbought signals could just be worked off over the next month without triggering my particular sell signal to just get out of equities. So I'm still cautiously optimistic on equities. I don't expect them to be off to the races, and I'm looking for and accumulating treasuries, especially the shorter terms, 2 years and 5 years, but not backing up the truck either. So that's pretty much what I wanted to share with you today. Happy to talk about other things if there's other things you wanted to talk about. But to me, that is the big picture. Sorry about the lighting today. The sun's coming in the window. And yeah, so it is a tricky time in markets. It's a time that we have to be paying closer attention than we might usually. Have to be really paying attention to what time frame we're working on, right? If we're really just managing a retirement account for 10 years, we can't get too caught up in these moves. If we're trading, day trading or swing trading, totally different story. So let's see what's on your mind. Isn't it remarkable that around 21st of March seems to be low in several assets. Triple witching day, spring solstice, or equinox, I should say. Yeah, it is interesting for sure. Interesting that weaker USD is leading to stronger commodities. Copper. Not sure what time frame are you talking about here, NH? Because the USD has been anything but weak over the past, since Trump got elected, right? And even a little bit before then. Maybe you're talking about the last couple of days, but time frame matters, right? If we're talking about something over months or years, totally different than hours and days. Mark, thanks for joining us. Any thoughts on silver for the next 60 to 90 days? Maybe we'll cover that next week. I might take a quick look today. Silver buy signal next week, high in May. We can take a look at that. Brand, something interesting with March 21st and for all approximately since 1986. Yep. Seasonal trades. Excellent comment, Mark. Thank you. Great to see you all talking to each other. I love that. Question about using the cycle scanner. How can I deactivate the FLD via the 3 dots in cycle table? All right, Dan, let me just do a quick share on that. Maybe once I get through all the questions, remind me if I don't get that, if I forget about that. Decline was January to March. Dr. Smith, can research verify this finding of decline timing and percentage? Decline on what, Mark? Yeah, maybe give me a ping on that. Markets that refuse to correct will crash. Richard is correct. First cycle low in mid-January. Yeah, well, I think that's true, Cam, but I've learned to be very careful about not over anticipating a crash too. I think that's been one of the biggest differences in my success over the past few years is not letting the prospect of a crash really take me out of the markets. But this is why I talk a lot about situational awareness and why I have a few, really simple indicators like the one I'm sharing today about when to really get worried, right? So, and I'm very attentive to what time frame I'm operating on in different accounts and different investments, right? Like we're all operating on multiple time frames. We care about 3 months, 3 years, 30 years for different investments. So I think that all is really important. The Treasury chart starting to look bullish. Yep. I mean, I'd really like to see Treasuries bottom. I do think there should be some significant rallies in Treasuries this year. If we think back to the 70s and what was happening with inflation back then, we got those 3 big spikes, but they were spikes, right? That meant it really came down a lot or it went back up a lot. So the 70s is still kind of my model of what we're faced with today. BTC collapse. Most of the work that I pay attention to still is expecting another up leg for BTC before all is said and done. If the pullback in stock should occur, definitely we'll see a bullish flight to Treasuries. All right, let's go take a look. Just a couple of things before we wrap up for today. There was one question about the FLD and the 3 dots. So you can turn the FLD on, which is the forward line of demarcation, right? I think that's a Hurst idea. And you can turn it off here. So hopefully that answers your question. There's another 3 dots in case anyone's paying attention. But over here, there's 3 dots for each cycle. And there's a few pieces of information in here that you can get. The info box tells you, this cycle, 83 periods, and this is daily data, uptrend starting, profitability 62%. And we can switch back and forth. You can do the FLD also, so it's there too, and the cyclic RSI as well. So sometimes you have to turn off by clicking here on this info box thing just to turn it off. And then you can see the cyclic RSI. So that is a little bit, yeah. So you might have to turn the FLD off there. Doesn't seem to turn off here. So yeah, good point. And then the cyclic RSI, you can activate it for any cycle by going here. And then the one other thing you might have to do is turn off this info box. This is here, this line, this little cycle that shows up here when you have the info box activated is something that we're working on. We've talked about it a little bit before, but you do have to close that info box in order to get the cyclic RSI to show up again. And then you can go here and turn off the FLD here. All right, hopefully that answers your question. So let's take a quick look at metals and silver. So here's silver. We got some short-term cycles bottoming, but longer term on the daily dominant cycles, probably a good place to start. So what do we got? A 36 period. That's pretty short term for me, but okay. And 94. So from the daily cycles perspective in silver, definitely got some tailwinds, right? We go all the way out to this, what is this, 324? That's pretty long. But I'd say there's some tailwinds, bullish tailwinds from the cycles. And if we looked at anything shorter term, a little bit of caution from the hourly data, the 2 hours and the 4 hours. Well, the 4 hours and the 2 hours, nothing uber bullish. But that daily buy signal looks interesting. And to me, the way I use this now is I look for a good signal. Like, let's say this buy signal on equities here on the stock market on the daily signal, right? So looking for, I might be interested in this pullback today to start to get a little long position for this daily cycle. Meanwhile, it's very edgy with everything going on. So I'm not going to pretend that anybody has a crystal ball here. I certainly don't. I'm in the thick of it every day, doing battle. And that's just the reality of markets today. All right, gang. It's good to be back with you. And again, 2025 is a time to stick together. So appreciate your support here at the foundation and your collaboration. Tell some friends, help us to grow and have a great 2025. And if you're interested in joining me for my in-depth coaching course, 3-month coaching course, please don't forget to look in the show notes and click on the link. And it's going to be intense, but it's going to be good. So thank you so much for joining us again today and throughout the year. Happy New Year. And we're going to have a great time. So see you next week.